Trading is about buying and selling assets. It involves a dynamic environment where prices fluctuate constantly and decisions must be made quickly. These assets can be stocks, bonds, or other financial instruments. Each type of asset has its own characteristics and behaves differently in the market. The goal is simple: buy low and sell high. Successful trading requires knowledge, strategy, and careful risk management. Traders must stay informed about market trends and economic indicators. Understanding the tools of the trade is essential for any investor. This includes trading platforms, analytical tools, and financial news sources. Trading can be lucrative, but also risky. Market volatility can lead to significant gains or losses, so it's crucial to be prepared for both outcomes. It's important to approach trading with a clear understanding of the markets. This means continuous learning and staying updated with the latest financial news and trends. Beginners should start with small investments. This allows them to learn the ropes without risking too much capital and gradually increase their exposure. As they gain experience and confidence, they can take on larger positions. Education and research are key to making informed trading decisions. Attending seminars, reading financial reports, and engaging with the trading community can provide valuable insights. Buy and sell orders are the backbone of trading. They are the fundamental actions that drive the market, allowing traders to express their intentions and strategies. They tell the market what you want to buy or sell and at what price. This information is crucial for the market to function efficiently, as it matches buyers with sellers. A buy order means you want to purchase an asset. This could be anything from stocks to commodities, and it indicates your willingness to pay a certain price. A sell order means you want to sell an asset you own. This is your way of telling the market that you are ready to part with your asset at a specified price. These orders can be placed at market price or a specific price you set. The choice between these options depends on your trading strategy and market conditions. A market order is executed immediately at the best available price. This type of order is useful when you want to ensure that your trade is completed quickly. A limit order is executed only when the asset reaches your specified price. This allows you to control the price at which you buy or sell, but it may take longer to execute. Understanding the difference is crucial. Knowing when to use a market order versus a limit order can significantly impact your trading success. Market orders guarantee execution, but not price. This means your order will be filled, but the price may vary depending on market conditions. Limit orders guarantee price, but not execution. Your order will only be filled if the market reaches your specified price, which may or may not happen. Trailing stop losses are essential for managing risk in the volatile world of trading. They automatically sell your asset if the price drops by a certain percentage, ensuring you don't lose more than you're comfortable with. This helps protect your profits and minimize potential losses, giving you peace of mind. Think of it as a safety net for your investments, catching you before a significant fall. Setting a trailing stop loss is easy and can be done in just a few clicks. You choose a percentage below the market price, which will act as your threshold. As the price rises, your stop loss rises too, allowing you to capture more gains. If the price falls, your stop loss remains fixed, preventing further losses. This allows you to lock in profits while letting your winning trades run, maximizing your potential returns. By using trailing stop losses, you can trade with confidence, knowing that your investments are protected. Section 4. Practical tips for effective order execution. Use limit orders to buy at your desired price. Avoid market orders unless you need immediate execution. Set realistic price targets for your trades. Don't be greedy. Always use trailing stop losses to protect your profits. Adjust your stop loss as the price moves in your favor. Monitor your trades regularly, but don't overtrade. Patience is key in trading. Section 5. Common mistakes and how to avoid them. One common mistake is setting stop losses too tight. This can lead to premature exits from potentially profitable trades. Another mistake is not using stop losses at all. This exposes you to unlimited risk. Avoid emotional trading. Don't let fear or greed dictate your decisions. Stick to your trading plan and manage your risk carefully. Remember, every trade has a winner and a loser. Don't let emotions cloud your judgment. Section 6. Mastering orders for superior risk management. Mastering buy and sell orders and trailing stop losses is crucial for successful trading. These tools help you manage risk and protect your capital. By understanding how to use them effectively, you can improve your trading outcomes. Remember, trading involves inherent risks. Never invest more than you can afford to lose. Continuously educate yourself and adapt to changing market conditions. With practice and discipline, you can master these essential trading tools.